Good morning and welcome to the Saxo Bank Morning Call. It's Friday, March 8th, 2019, and we have a lot going on in markets. If we've been complaining about low volatility recently, we certainly cannot make that complaint. Today, overnight, Chinese equities down several percent, apparently on a broker downgrade being seen as sort of an official warning not to get too speculative or too indulgent in the speculative froth in this market. So I think setting the tone on the mainland of China. But elsewhere, of course, it was all about the ECB yesterday and a dovish pivot there. And yet the market's not feeling the love. I got some equity. We'll talk about the ECB in a second. I got some equity markets here, though. We see the S&P coming off with its worst session in quite a while. And we have more firmly now this technical top in place. Let's go straight to the DAX. Not celebrating, interestingly, the dovishness, this dovish turn from the ECB. We're seeing lower guidance in terms, or delayed guidance in terms of the timing of that expected rate hike. We're seeing a slashing of inflation and GDP forecasts, especially that GDP forecast slashed all the way to 1.1% from, I think it was 1.7% just a few months ago, the expectations for 2019, and as well a strong cut to the inflation forecast. Really a strong signal that the ECB is firmly in the dovish camp. And then they went ahead and announced a TLTRO, which was expected, but announcing it now rather than waiting for future meetings. I think that was seen as a dovish, erring on the dovish side as well. And we see one of the reasons for the lack of a follow-through in equities or interest in buying equities on this event. In the Eurostoxx Bank Index, I've got a chart here. You can see how this sort of negative rates, flattening curves, not celebrated in the banking sector in Europe. What was celebrated, though, was Italian BTPs, the Italian sovereign futures there. A tremendous rally over the last couple of days as they're anticipating an ECB move. I'll say I want to bring you into the discussion. We're seeing a big compression in these spreads in Italy because of, and the periphery in general across Europe because of this move by the ECB.
Yes, absolutely. Actually, the European BTP, the Italian BTPs yesterday were the best performing sovereigns in Europe. We have a table here that shows us in the next slide. That shows us how basically European sovereigns have been rallying, and of course Italy is one of the outlier that has been rallying the most. But the most interesting thing here is that while all sovereigns have rallied, Greece instead has been falling, and I believe that this is a very interesting point because it shows that. While other countries have a strong domestic investor pool, Greece instead, the majority of the investors that are investing in Greece are foreigners. So obviously, as soon as there is some risk perceiving factor and so forth, investors will flee to their own sovereigns. And this is a big point because it means that, yes, we are going to see...
So funding for Greece could come under threat, in other words, if we continue to see this pattern.
Exactly, yeah. And it's important to select not only corporates but even sovereigns in this kind of environment.
And your other point here is that the high yield risk suddenly spiked back up. Fits, of course, with the risk off we're seeing in equity markets.
Yes, this graph that we have here shows actually the trading of the crossover during the day of yesterday. And as you can see, around the time when the ECB announced these policy measures, there has been basically a rally in high yield corporates, and then the spread of the crossover started to widen back up. So this is
interesting two-part reaction. So at first it's sort of celebrated, hooray, central bank easing central bank accommodation, hooray, and then we see the big turnaround actually closing back lower, or higher on the crossover but lower in terms of risk appetite.
I believe that the big message here and the big question yesterday with the TLTRO programs of Draghi is that banks and the financial system in Europe has been functioning quite well as the economy was recovering, although rates are negative or close to zero. But now that we are seeing an economic slowdown in various countries of the European Union, are banks going to be able to stand basically the weakness that we see at the moment?
Yeah, so classic credit cycle, basically.
Exactly.
Yeah. Okay. So Ola, we have, oil doing nothing. I thought that was a very curious point. I wanted just a brief, we don't have any charts, but I want a brief comment on oil, maybe why it didn't react in line with a stronger dollar, risk off, etc.
Well, I did mention yesterday, and I have been saying all week that I feel the upside to oil is limited at this stage because there was a risk of this rollover in stocks, and we saw that yesterday. And with the dollar also strengthening, oil is trading a bit lower. But there is still some concerns about Venezuela, and I think that's really the reason why we're not really seeing any kind of not capitulation, but some profit taking coming into the market, because the markets still worry about the potential supply shock there. So I think that's keeping the market supported. But overall, I still look for that to.
Saw a news item out from Bloomberg or somewhere overnight that Venezuela, the lights have apparently gone off in Caracas and in much of Venezuela. One wonders how long this kind of a disruption.
It's most certainly a situation that continues to develop. That's for sure. But I think talking about the commodities, let's take a look at the chart here, because I brought with me the gold chart, and gold has been under pressure now for a few weeks. This is basically a 2-hour chart going back to the peak, and this showing the latest sell-off. You can see yesterday when the dollar started to rally, gold actually stayed unchanged and eventually started to move higher. It basically means that the gold for now is keeping a close eye on stocks, and probably also yields. 10-year yields are almost back down to the lows that we had for a couple of weeks ago. So that's really overriding the rally in the dollar we've seen, and that's most clearly shown on the right, where you got gold price in euros. We have already covered 38.2% of the sell-off, and you can see we've broken the trend line. We're nowhere near doing that in gold yet. So 1306 is we can rally to 1306 in gold and still get rejected. So that's really the level to look out for on the upside.
1306 and gold in dollar terms we'll be looking for there. Okay. And then in copper, Dr. Copper is supposedly one of these leading indicators in the economy. It's rolled over a bit, but it's not exactly impressing on the downside.
No, copper is doing very well because of the outlook for tighter fundamentals. But when we have this big sell-off in China overnight, and we've seen this weakness emerging in stocks, then it does increase the risk that we may see some profit taking in the short term. If you look at the chart here, you can see that we're just hovering around this 290 level this morning, and we are looking for a potential move down towards the 280. I don't see much lower than that, because as I said, fundamentals are tightening. That is providing some support, but just in the short term, if we see continued weakness, copper could be at risk.
All right, now let's turn to currency reaction here. Of course, with the ECB managing to clear the dovish expectations bar, we're seeing a weaker euro. And I have a chart here of euro dollar where we're importantly and finally, we saw one of the most compressed multi-month periods. I mentioned this yesterday, 3 calendar months with a trading range of about 3%. It's never happened in euro dollar's history. We're finally breaking below the range. The question will be, will it hold? We've got a key U.S. data today. You can see how that previous break below 113, that's the upper line there, was a one-day wonder that quickly reversed and bogged down into that range trading for 3+ months. So really important for whether we get some momentum out of this move to see if that move holds and we can progress towards 110. We know the Fed is pivoting dovish. Just yesterday we had the Fed's Brainerd out indicating she is lowering her expectations for growth and has said previously she thinks this QT needs to be wound down. So we'll be looking for those developments incoming. The next key risk point will be the next FOMC meeting, which is the week after next. Also of interest, if we look across the majors, it's not just dollar strength and euro weakness. It's also yen strength with this risk off with sovereign bonds bid across the board, especially with EM, those EM carry trades all suffering with this weakening of risk sentiment. We're seeing the yen really rising fast here, and you can see the last couple of sessions have seen a tremendous reversal in fortunes for yen crosses, euro yen here, the focus, and even dollar yen has come off. So I think if this backdrop continues, we're going to see the yen being the star performer in this kind of market environment. Now, really switching gears here, Ola, we were talking yesterday, you and I, about this. There's been one of the big trends going in commodities is the big fall in wheat. And we have a big key agricultural report coming up today.
Yes, we have the monthly WASDE report covering the month of March. Just putting up the table here, you can see primarily the market will be focusing on ending stocks because it's too early to start guessing what the production this year is going to be. But we're looking at some of the movements there. Ending stocks, corn looking to be raised, and the same goes for wheat, while soybeans is potentially seeing a reduction. But also that time around, we're going to see some data for Latin American production for this current season because they're currently in the process of harvesting. I brought with me the soybean chart. chart, the wheat chart, as you mentioned, looks really ugly. The soybean chart has been supported by the trade talk hope, but these trade talk hopes have really faded, John. I mean, we don't.
Are we going to see a sell the fact? You think potentially?
I think
on
there's.
soybeans?
I think there's a risk of that. I think there's a risk of that across markets because so much has been priced in to this trade deal to save the world, but. The fact we're not hearing anything.
Trade deal to save the world. I like that. Yeah.
The fact that we're not seeing much, it does raise some nervousness that we may not get a deal that can turn the ship around.
And the trade deal to save the world is not on my calendar, but we all know it's upcoming. That announcement, I think it really is a key test for markets. Just a sentiment test, regardless of what the actual content of that deal is. Our suspicion has been that it'll be maybe impressive on the headlines, but then the enforcement and the long-term issues over the fraught U.S.-China relationship is going to mean maybe the impact is rather limited. Let's go to our macro event calendar for the rest of today. Of course, it is an important day with the usual first of the month U.S. jobs report. Not sure how it adds into the mix unless we get some really big shocks, either especially to the downside. I would say it would maybe ruin some of the dollar strength narrative and sort of point to maybe more of a risk off and dollar yen downside narrative if we see an exceptionally bad report today. I have no read on the expectations here, but that we are looking for an average hourly earnings number expected to print a new high for the cycle, and this is is going to at the margin make the U.S. look better than elsewhere. Non-farm payrolls change, we'll see that one as well. And then we have that WASDE report, as Ola discussed, at 5 o'clock. Look out, over the weekend we have a couple of major appearances by the Fed's Powell. He's speaking at Stanford, I believe it is, where there will be a Q&A session after his speech, and then he's doing the 60 Minutes, the very prominent U.S. TV program, news program, 60 Minutes on Sunday. So look out for that. Next week, interesting data, but nothing like what we saw this week, and it'll be all about the follow-through from this week's developments. That'll be it for today and for this week. Have a great weekend, and we'll see you back next week with the Saxo Bank Morning Call. Thanks for joining.